Good morning. It is 9:30. It is 9:30 a.m. and as promised, I will be doing the Instagram live with David Ghazaryan, our mortgage broker. David, you have a little icon that shows to invite you as a guest. Your excited is the local mortgage broker. The reason for this Instagram live is that on our Instagram you get to post the questions to me, and a lot of those questions, they are actually, hi David, how
Good
are
morning.
you?
Good morning, Alexandra.
Good morning. So David, I was just saying that the reason for this Instagram live is that I get a lot of questions on my Instagram page in regards to mortgage and the rates and everything that is going on in the industry right now. And as much as I love answering the questions in regards to the market, the real estate market, I cannot actually answer the questions about the mortgage industry, what's going on with the rate, and that's why I'm so grateful you actually agreed to join me today and give us some answers to the most important questions. So there's some questions that we received, and everybody who is watching us live is actually welcome to post their questions. We'll try to address them. If by any reason we did not get to address your question, then you can leave it in the comment and we will go back to this video in our on our Instagram accounts and we will answer those. If by any chance we don't have a short answer to you, then watch us next week. We'll do it again. Does it sound fair?
Sounds fair. Glad to be here.
Excellent. So for those who doesn't know you, guys, this is David Ghazaryan. He is the owner and the main broker of the IQ Mortgage. They've been working here in town as one of the best, the most serviceful, and the most customer-friendly mortgage and lending offices in Las Vegas. We're happy to work with the guys, and they've been licensed since 2005, helping thousands and thousands of clients, including bilingual clients. David, how many languages do you speak in your office?
Oh gosh, four or five. We speak languages.
Absolutely. And as well as you helped a lot of our clients who were not even residents of Nevada. So David is licensed in many states. We're not going to name them all at the moment, but in the end of the stream, guys, we will be posting David's information. You can follow David at the mortgage broker on his account, and you will see his contact information. So feel free to contact David and his team at any time. But let's jump right into it, David.
Thanks, Alexandra.
So the most commonly asked question is, the question number one that everybody's interested in: should I buy the house right now? And it is like from the standpoint of the mortgage. I know you're not going to comment on the housing prices. I can do that, but like from the standpoint of mortgage, like what is going on?
Okay, so should you buy a property right now? In my opinion, I am seeing. I tell you what I'm seeing. I'm seeing more people that have smaller down payments get their offers accepted now as opposed to a year or 2 years ago. So it is a more opportune time for a lot of clients to have their offers accepted with relatively smaller down payments, for sure. Yes. So yes, by all means, you should buy a property right now. In my opinion, it's a great time to buy.
So I would say that you can see a lot of opportunities for those buyers who did not have the chance of getting in within the last 2 years.
Absolutely.
Like from the standpoint of the real estate agent going through 2020, 2021, the majority of 2022, we had multiple offer situations. We had to overbid a lot of offers. So in those people who had the minimum down payments, those people who are like even our VA, like most of our VA
Right.
buyers, they were struggling because of the absence of that down payment. Because of the absence or the little down payment, as well as not being able to cover this huge gap that would always appear between the appraised value and the purchase price that we had to offer in order to get the property, in order to have the offers accepted. But David, like we've worked with a lot of clients within the past, let's say, I would say starting probably August or September, we started seeing this really awesome trend with our buyers where we're asking for closing costs.
Yes.
So,
Yes.
and I know you work with, you work with hundreds of agents in this town. And tell me, is it just me in my office, or is it an overall trend that when representing the buyers, agents are actually asking for closing costs and sellers are actually offering those closing costs to either lower the rate or cover the expenses of buying the house?
So it is prevalent now, obviously, just because we're in a buyer's market. We are seeing more and more sellers offering or agreeing to our request. This is a tandem request with the broker and the buyer's agent when we ask for concessions. And in fact, last night, I got an $8,000 concession for my buyer, and she didn't even expect this. But this was a nice surprise that I got, and the seller's very grateful. The seller gets to move the house that otherwise it wouldn't have moved. So by all means, we are seeing this, and this is a great help towards lowering the interest rate going from 7 to 4 in some cases. So it is such a great help in alleviating some of the fears, and we are seeing more and more of concessions right now.
That is awesome, and you actually touched on my next question.
Okay.
So, let's be honest. We're here today, you and I, is to help people take the opportunities in this market. And when people are reading those headlines, those are not helping. Those creating nothing but panic and the frenzy. So can you tell me, from the standpoint of a professional, from the person who's been in the mortgage industry since 2005, so you've seen it through the year of 2008, you've seen it through the 10th, so can you talk to us about the rates and where they are right now, what are we expecting, and why? Is 7 really a big number? Is 7%, is it a high number?
That's a great question. It depends from your perspective. It depends on how wide your perspective is. If you're gonna, most people have a very fresh memory of the pandemic rates. Pandemic rates meaning after 2020, when Federal Reserve had no idea how to deal with it, they artificially lowered the interest rates, and that's very fresh in people's minds. And it was too good to be true. The 2s and 3s. And that's why we have what we have today. We're paying the price for those too good to be true rates. I was at church one day, and I was speaking with one of the elders, and he said he had an 18% rate decades ago. I think in a healthy economy with healthy inflation, 5.5% is where, in my opinion, the interest rate should be. And I think when rates start going down, they're going to be around 5 to 5.5%. We're not going to see 2 or 3%. I don't recommend anyone hoping for that.
Okay, so 5 sounds really good, especially, looking at 7, 5 sounds like a dream. So can you tell us, if you obviously don't have a crystal ball, but what is your expectations from your standpoint, from your experience? When do we expect to go to 5s? And what is the time frame? Like, is there a time frame or there's no guarantee? Like, what is the Fed
That's
saying?
good.
Like, as far as I've heard, they're raising the rates all the way until July. So when are we seeing fives?
So, Fannie Mae is the leading agency when it comes to mortgages. It's called Federal National Mortgage Association. Their economists have predicted rates would be in around 5.5 around May or June. So that's Fannie Mae. There are other number of leading economists that have said the rates are going to slowly creep down. There are several factors. The Federal Reserve raised the rates over 4% in the last year. This whole thing happened because the steep curve of rates increasing happened in 1 year that's never happened before. That's what we had last year. Now, this year, the Federal Reserve said that he's only going to increase the rates only about 1%. So I think you're right. He'll be done around May or June of increasing rates. But so that's the negative news. The positive news is the CPI, the inflation index has been extremely positive. It's been going down month after month after month, and tomorrow is the 12th. We're expecting to see the December CPI index, so quite possibly tomorrow we'll have another good inflation index, and if inflation keeps on decreasing, then we're going to see positive rates, low rates, sooner than we expected.
And CPI, it is
Consumer Price Index.
which is AKA the level of inflation, the monthly level of inflation,
index that
correct?
the government monitors in inflation at the different price and goods over the last 12 months. So your viewers can Google CPI index, and it's a government website, and they can see it's going to be out 8:30 a.m. tomorrow morning.
Okay, so thank you for answering this one. Now, if I cannot wait, like, I need to move right now. My lease is up. My lease is up at the end of January. You know, like, what is, like, am I supposed to go month to month and wait till the rates drop? Has Fannie Mae been wrong before? They sure were. You know, like, should I trust them, or what? You know, like, what am I supposed to do with the rates?
So honestly,
you know, like,
yes, I don't never recommend clients to focus on the rate. The rate is such a thing. There's the cliche, date the rate. Don't marry it, marry the house. So a rate is temporary. In Las Vegas, most people move every 3 to 5 years. So my suggestion is get ready, get qualified for the mortgages. The number one thing you can do in January is, first of all, see a loan officer. If you're planning on buying this year, see a loan officer before you file your taxes, before you chase that refund. See a loan officer, see what you need, whether it's to pay down debt, especially if you're self-employed, you have some certain of degree of influence on your income that you could show. See a loan officer, see a tax person, get your affairs in order as far as your credit and income, and to be able to purchase. That's the best thing you can do in January is, number one, understand whether you can buy. Most people are falsely positive that they can buy a house, but it's not that easy. So make sure that you do qualify. I mean, talking to us doesn't cost a thing.
So can you go a little bit deeper into it? Why, if I even have a thought, maybe, you know, like purchasing, let's say, in fall of 2023, why is it important for me to actually consult with the mortgage specialist and with the tax? Like, why do I have to do both? Like, how are they connected? How are they interconnected, and how it's going? How is my actions of January are going to affect how much house or how much mortgage I can afford in the fall of 2023?
Sure. So let's say we're in the fall, and a lot of times when we get the taxes after the fact, a lot of the CPAs, well, their tendency, their goal is to reduce the tax exposure, is to try and get their client as much refund as possible. So that's the goal they have in mind. And once you see taxes, especially if a person's self-employed, there's a number of things, the amortization, depreciation. That they do take advantage of, and the person all of a sudden doesn't qualify. So, speaking with a loan officer, understanding what you currently qualify, understanding what you need to do to qualify to buy the house is important, is crucial, even if you're not planning on buying right now. Otherwise, when you do your taxes, then apply for a mortgage, it may be too late.
And I would say that, like in our practice, we don't really take people house shopping unless they have the approval. And it's not because we're mean people. It's because we're just trying to avoid wasting the time and the disappointment when people like the house that is worth $700,000, and then later on they go and see the mortgage officer, and then they figure out that they only qualify for $500,000, and now they don't like anything that they've seen. And there's a lot of frustration in this capacity. So, David, am I correct, or you have something special for everybody who is watching us live, or for anybody who will be rewatching this this video later on? Like, I know you're committed to the excellent customer service, and I know you you and your guys always go above and beyond for every single client that we work together. Like, this is truth, this is truth, and I'm sure that, all of the reviews, and a lot of them are written by our clients, and I will confirm every single one of them, not yet we had a client who would say didn't have a good experience or they didn't do an excellent job. So tell me, please.
What's the offer?
Yes, what's the offer? Like, how are you, with your commitment, how are you and your company helping the customers today, for those who are not sure if they're buying this year, or they're thinking of buying this year, or those who just need some guidance and the professional advice without getting their credit pulled?
Okay. So what we're offering now, and one of I would say the most crucial thing to do in January is to, like I mentioned, to see a loan officer and a tax person. So since my wife and I, we own a tax preparation firm, we are offering a consultation, free of charge, no obligation consultation to people that would like to see what their financial situation is, and to get educated on taxes, on income, and how to organize their life, the right foundation. The mortgage is not the only one. People are going to get more and more mortgages in their life, and the right foundation. It's interesting how people don't have the right education, especially if they're Uber drivers, Airbnb, whatnot, especially if they're self-employed. So we're offering a tax consultation up to $500. That's the value that it entails. So they can have a better idea of how to plan their income, their financial situation, so they will qualify in the future when they apply.
Wonderful. So once again, you guys are offering free tax consultation and free credit consultation.
Absolutely.
Is that correct?
Absolutely.
Absolutely.
Yes,
and
absolutely.
how do people contact you? Like, how can they use this offer? Like, what are they supposed to do?
I would rather if they called me first or emailed me, and then I'll point them to the right direction, to the front desk. The company's called IQ Tax, and we'll put them on a calendar with the right tax professionals, and they can go sit down, have their consultation, and trust me, we have really good professionals that will give them an hour worth of education.
Excellent. And that is regardless whether you're W-2, whether you're 1099, or whether you had been switching back and forth.
the W-2 has less opportunities in a sense for expenses, but there's still things you could do in terms of IRAs and stuff. So you still want to sit down and have a conversation, especially if I'm giving it to you for free.
Awesome. And one of the questions that we have, like when people are getting their tax dollars back, when they're getting refunds,
Yep.
are they allowed to use it for the down payment?
Absolutely. It's their money, of course.
Excellent. Another question is that when people get the concession from the sellers, are they allowed to use it towards the down payment? Like what happens to those money?
No, the concessions cannot go towards the down payment. All the guidelines, regardless whether it's FHA, conventional, require the down payment to come from the buyer. The concessions can go either towards closing costs or to buy down the interest rate. You could pay taxes with it, you could pay the HOA dues, insurance, what have you. So a lot of times, especially recently, we've had some creative loan programs, the 2-to-1 buy down, 3-to-1 buy down. So the concessions have been instrumental in applying those funds to lowering the interest rate up to 3% or 2% from today's rate. So getting a rate in the 5s or 4s, even if it's temporary for the next year, is not impossible. It is possible. We've done that before for buyers, and it's not costing them a thing. The sellers paying for it, quite happily paying for it.
So, David, and there's a lot of, there's a lot of things, like to me, it sounds quite complicated when you have to explain it to the consumer, like when people are asking me, should I buy down the rate? Should I not buy down the rate? Like, I'm not sure, like, I'm buying the house right now, my rate is 7, but everybody says that, what if it goes down to 5 at the end of the year? Am I supposed to buy down? Like, I have this money, what do I do? So is there, like, are there key points that you look at and you talk through with the buyers, like, should you buy down the rate or should you not buy down the rate? And in which cases it is the best to buy down, and in which cases you should say, now I'm going to refi?
So there is a simple formula, and I'll give you the formula quickly, but quite often, even the experienced investors get lost in this rate conversation. So what you want to do is you want to calculate how much money you're saving per month when you buy down. Okay, so let's say a $7,000 buy down is going to save you $300 a month, for example. And this is a conversation I had yesterday with a client that he wanted to spend $7,000 and save 1 point on his rate and save $300. So we basically took the $7,000, the cost, and divided it by the monthly savings. That ended up, and then he had the number of months that would take him to break even. Okay. Now, once you have your break-even period, whether it's 20 months, 22 months, in some cases it goes up to like 7 years. So once you have your break-even period, that's when you decide. We don't decide, we're loan officers, we're just providing information. The client decides whether they want to do the buy down. In this case, the client was going to break even with his $7,000 investment in 22 months, which is, well, let's say 2 years. And he was like, no, David, I think rates are going to drop in 2 years, so I'm going to refinance anyways. So why would, and I said, okay, I agree with you, and you said it. So why spend $7,000 now if you're going to, you won't have broken even, and we will refinance you, so it's a waste, in my opinion. So we're happy. We've got the software, we've got all the tools to compare, but you take your monthly savings and divide by the cost, then you'll see what your break-even period is.
And there are a lot of people, and thank you for that, but there are a lot of people, they're getting so zoomed in on the amount of money that they're overpaying, like, let's say, paying 7% interest versus paying like 5% interest.
Sure.
Like, how do you deal, what is the point of view? Like, what kind of, like, from the bird's eye view, like, tell me, like, should people be, like, zoomed in on this amount that they're overpaying per month, or they should just take it as, like, okay, I'm going to write it off on my taxes regardless?
Well, write it off taxes is just an added benefit. That's not why you should buy a house. But I always tell people it's been a never-ending conversation. Do not focus on the payment. The time will come, we'll refinance you out of that thing when rates drop. Focus on ownership. Focus on owning a house sooner rather than later. So those that have owned homes sooner, years before, have accumulated hundreds of thousands of dollars of wealth. So I would rather be happier if people looked at home ownership as a means of building wealth, a part of your portfolio, if you will, instead of just comparing home ownership to rent and comparing how much it increases or not, because there's other things. The mortgage payment, we say a rent is 100% interest because none of it is yours, it's your landlord's. When you make a mortgage payment, at least several $100s gets applied to your principal, so your equity grows. There's investment aspects to a mortgage, there's net worth aspects to a mortgage that rent does not have. So it's not always an expense decision, I would say.
And I want you to actually dig a little bit deeper, like here in Nevada, what our regular mortgage payment consists of. Hi, Becky. Thank you for joining us. We have a top performing realtor from California, Miss Becky, joining us. Becky, if you have any questions to David, our mortgage broker, please feel free to ask. David is licensed in California as well. Correct?
Yes. So your question was what do I tell people?
What goes into the mortgage payment? You know, like that's one thing, and then another thing, like when we're talking about the parts of the mortgage payment, which part of it goes to you, which part of it is getting written off on taxes, and which one do you put into your pocket, or like which one you benefit from, and which part actually goes into the bank, like you're giving it to the bank.
Got it. So when you say goes to you, goes to the buyer. So when you make a mortgage payment, especially a 30-year fixed mortgage, I don't recommend any of the ARMs, adjustable rate mortgages. Lots of people got burned. So let's talk about the 30-year fixed mortgage. Most of it, there's no specific formula, but most of it is going to be interest, especially in the beginning years. But some of it is going to get applied towards principal. And besides the principal payment, there's going to be the insurance, homeowner's insurance. You will have, if you put less than 20% down, let's say you put minimum 3% down, you will have a mortgage insurance, you will have property taxes, and you may have homeowner's insurance. So all of that is going to comprise your mortgage payment. Well, mortgage payment does not include homeowner's insurance. So having said that, several $100s, $300 to $400 on an average mortgage in Nevada gets applied towards your principal, which means your principal payment gets reduced, your equity position increases.
So that's why, like I've heard once one of the mortgage professionals calling your, like whether it is your primary residence or like any property that you own and you have a mortgage on it, they call it a piggy bank. Like imagine it's like a piggy bank that you put like $200, $300 off equity, whatever it is, every single month, and then at some point you get to cash it out.
So I have a special tool that shows your amortization in different loan scenarios. So I used to call that skip the Starbucks presentation. So if you get a regular $350,000 mortgage at 30 years, and if you were to apply an extra $150 to $200 to the principal out of pocket, which is basically skip your $5 latte every morning, then that would shave off almost 5 years off your mortgage. So you would be mortgage free in 25 years.
Oh, interesting. And yes. Do you recommend to make extra payments, or do you recommend to just go and just go and make your regular payments? Like how do you determine what's the best? Is there like one size fit it all? Is it all individual? Like how does it work, or is it like a general rule of thumb that you talk about?
It's a good question. What I talk about, I have an investor mentality, so the conversations I have with clients are always going to be geared towards building wealth. That's my focus. That's what I've done for myself, and that's where it really gets me excited. So I will talk to a person on how to build wealth, how to upgrade their homes and live in better homes and have rental homes, how to build faster accelerated equity in the home, and build a portfolio, because probably the most common dream people have is have a bunch of rental homes, do not work and travel. It's such a cliche, and it's possible. And I think I'm building that, and I do talk to clients and teach them how to build that. But there are clients that are very focused on the monthly payment, and they compare it to the rent, and that's all they care about. And that's what I'm going to limit my consultation to.
So, like I talk to a lot of my clients who own more than one property. And there are people who don't like to have debt and they want to be debt free. And when it comes to prepaying the mortgage, I always say, pick the property with the highest interest rate and prepay that one first. If you are to, if you are to pay off one of the mortgages, if this is your goal, like pay the one with the highest interest rate. Is that correct, or am I stepping my boundaries over here?
Well, I don't know. I would also send them to their CPA to get a consultation, because the highest interest rate is also going to give them the highest deduction if they live in the property. So is that the property that's rented? That's a bit of advanced conversation, I would say, which property to pay off first. I don't like paying off properties, honestly. I like to keep a very healthy equity position in homes, 40%, 50%, 60%, but I don't like mortgages, homes ever being paid off. Understand that we're always going to have inflation. We're always going to have inflation. That's what you need to have in a healthy economy. When you have inflation, in my opinion, the best tool against inflation, your best hedge, is the 30-year fixed mortgage. When you get a mortgage in 2022 at a $2,000, your mortgage is going to be $2,000 in 2052. Literally in 30 years, your payment is not going to go up. Guess what? If you rent that house, the rent is going to increase. Rent has increased 4% in Clark County year over year historically. I have a number to back it up. This means you're going to collect more and more rent, and your payment's never going to go up. Does that make sense? So that's my favorite cash flow tool, and that's how you build wealth. So should you pay off mortgages? No, mortgage is such a cheap OPM, other people's money, that you should take advantage of. But again, it's for the one-on-one consultation that we have, and that's a bit more advanced, I think. I get carried away.
No, that is very interesting. But can you tell me, like, I have $100,000 at the bank. Let's say I have $100,000 saved in the bank, and I am reading the headlines. I am watching people like screaming off the social media saying, "Oh, we're about to enter into another housing crisis. So the housing market is going to crash. Mortgages are high, like mortgage interest rates are high through the roof, like stock just crashed, like all the cryptocurrencies went
right.
Foo-foo." So, and people are like, should I let the inflation eat my money in the bank, but still have it in the bank or under my mattress, or should I actually make a down payment on the house and try to keep my money in the house? Like, what are my chances of keeping that money if I have it? Like, where would you find the solution of saving that money, even if I'm not trying to make more, just to save it?
I'm going to limit my answer to, I'm not licensed as an investment advisor, so I'm going to limit my answer to mortgages, to what I'm licensed and experienced to talk about. I have kept my money in mortgages always, and understand, one of my favorite things to explain a client is, let's say you're buying a $400,000 house, and you're putting 5% down, which is $20,000. You're financing 95% of this house, which is $380,000. Easy math. Las Vegas has seen 7% increase appreciation year over year. Let's say the home appreciates 5%. So you bought a house, and in a year, that home is going to appreciate 5%. This $400,000 home is going to be $420,000 in a year. What did you invest? $20,000. You just had $100,000, 100% ROI on your money. So that's how you should think about this. Your money should definitely be invested in mortgages, because when you get a mortgage, you get to own a piece of a big investment versus with a small down payment. Now, you can't go buy a whole bunch of houses and over leverage yourself. So you need to be careful with that. But when you invest your 20% into stock market and get 5%, 6%, you're so happy that you got 5% on your 20,000. Well, guess what? The $20,000 would get you a $400,000 asset that would appreciate, and you would get the 5% appreciation on the 400,000, not your 20%. That's why I'm so excited about real estate. That's
Excellent.
why.
Thank you, Becky, for joining us. Sorry, Becky's saying goodbye. She has to go and take another listing. We know she's super busy. California is not experiencing a slowdown.
Yeah.
Not at all. So you would say, coming back to our question, you would say that technically, if I keep my money in the bank, I'm guaranteed to lose whatever I'm going to lose to inflation, correct? No matter what. Like, well, I'm guaranteed to lose it, and not, like, if I just keep it in cash, whether in the bank or under the mattress, like, I am going to bleed a part of it to the inflation, whatever the rate of the inflation is.
You're not going to lose it. Your $100,000 will still be $100,000 in 100 years. It'll just be worthless. You will be able. It'll lose its buying power, right?
Power.
That's what you meant. It'll lose its buying power.
Thank you for correcting me.
But there are some investors that once you have debt positions, which is called leveraged buyouts, once you have your investments, once you have a whole bunch of other instruments that you've invested, you want to have some cash. But generally, if cash is all you have, you don't want to take a long position on that cash. You want to do something with it. Whether you're buying an S&P 500 or investing in real estate, you definitely want to do something with that cash, especially in such a high volatile market that we have right now with interest rates.
I want
inflation.
Agree with you. Yeah. Like, what happens is that, like, I understand that there's probably 100,000 ways of investing the money, but David and I, we're only licensed, in between the two of us, we are only licensed in real estate and mortgage. So we're not capable over here of giving any kind of, like, investment or tax advices. We're just talking about the things that we personally know about, that we're licensed in, and the things that we invest in, because we invest in what we know.
Absolutely.
That's our approach. Like, we're not the crypto or S&P 100, 500, or 100 investors. David, one more time. I know that we agreed on half an hour, but I can torture you for longer than that, and I think I will also, like, there's some questions that you and I didn't cover today, but I think it would be very interesting if you go deeper into those questions. Like one question Please. You probably can answer. How often can you buy a primary residence? Is it 1 year, 2 years, 5 years? How often can you buy a primary residence? It sounds very funny. How often can you buy primary residence?
That's good. That's a great question. So first of all, I want to give a shout out to Kevin. He joined, and he's a good friend. He's a real estate agent as well, and I believe we have some clients that we're working on together. So hey, Kevin.
Thanks, Kevin.
How often can you buy a primary residence? So if you're getting an FHA or conventional loan, which are basically government-backed, government-guaranteed loans, both of those agencies require 12 months, which means once you sign your documentation, you are pledging you're going to live in the house for 12 months. Now, that doesn't mean if you've got an attic full of scorpions or a very dangerous neighbor next door, you have to absolutely live there for 12 months. But that's what you're promising at the moment that you're buying a home to do.
You're talking about an honest intent.
Honest intent. You
Right.
cannot have a malicious intent of living in it for 2-3 months and then go buy another primary home. That's a no-no.
The short answer would be we can buy a primary home every 12 months, correct?
That's correct.
Like you're entitled. Now, does the primary home, like what defines a primary home?
Primary home is the home that you live in.
What if I live between
mostly.
the two states? If I live in between the two states, how do I define the primary home?
Well, okay, that's a good question, because there is this thing called second home or a vacation house that is not by definition rentable. You're not supposed to make money off it, but it's another home that you live at and spend some time. The majority of your time you need to spend in your primary home, which is generally measured by the city that you work in and you make your living out of. Most people, if they have to report to work, if they don't have remote jobs, they have to earn their earning, let's say at a casino or whatnot. That's where their primary home is going to be. Even if your primary home is a rental, that happens as well. You could rent in Los Angeles because you earn your money in Los Angeles. You could buy a second home or an investment home in Nevada. That's possible as well.
And one more. And I promise to let you go after this one.
I'm good. I've got time.
And so another question was, hold on, I need to cut it down to a shorter version of it. So as a first time home buyer, is there any benefit for the first time home buyer to buy today versus should I wait for the interest to go down and buy then?
So first time home buyer doesn't give you as many benefits as you would think. There are some programs that help, if you will, to first time home buyers. For example, we have a program specifically designed for first time home buyers where the low credit score does not affect the interest rate. One of the banks offers that to help out first-time home buyers, people that have low credit scores. So whether you have 640 credit score or 800 credit score, it does not affect the rate. You still have a decent rate. So first-time home buyers get some sort of help, but it's also important to understand that you're not by any means more attractive to the bank because you've never owned a home before. So that doesn't make you stronger, but you have no experience in owning a home, on being responsible for it. So they will help you to get become a home owner. For example, FHA would be a more or less good example of a first-time home buyer because it's hard to get another home if you have an FHA loan. It's not impossible, but it's hard to get. An FHA, you get a minimum down payment of 3.5%. You can have a low credit score of 580. So these are the attributes for first-time home buyers that some programs offer just to help people get into homes. That's not a privilege by no means.
And one thing that one thing that I noticed from working with our buyers, first-time home buyer is a very kind of beat up term.
Yes.
And you keep on hearing it, but it's not something that is, like you said, that is not something that is a privilege. And the majority of the first-time home buyers programs that I worked with before, when we saw the contribution towards the closing costs, towards the down payment or helping the buyers with the closing costs from those programs, those buyers end up with a lot of times with the higher interest rate unless they're entering into some kind of a grant program where that contribution is forgiven. Am I correct?
So there are different programs, again, for first-time home buyers. I could talk to a couple of them. Nevada is not as rich on those grants as, say, California would be. So Nevada Housing Division and U.S. Bank specifically have partnered up, and they're offering the DPA, Down Payment Assistance Program, where you can if you're a first-time home buyer and there's a whole bunch of other stipulations as far as your income and all, you may qualify up for the down payment assistance. In my opinion, in my experience, what I've seen, the rates are slightly more expensive. You're not allowed to sell the home. If you sell the home within a certain period, you're supposed to return the money. So you want to weigh in. It may be free money if you fit a very, very narrow box. So you want to, definitely ask questions before you apply for those mortgages, but they are available. Now, there's also the culinary union that offers the $20,000 if you've been with the union for 3,000 hours and all. That's not a grant. Even if you sell the house in 20 years, you're supposed to return that. There's also the WISH program that limits the income and the neighborhoods that you're supposed to buy in. And if you do qualify, that there's up to $22,000 of help, which may be forgivable, I want to say in 5 years. Again, we would have to look into more details for those programs. They're out there, but it's you definitely want to
So
weigh.
would it be, I'm sorry. Go
No,
ahead.
you definitely want to ask a lot of questions before you take the free money. Ask a lot of
So
questions.
the right approach would be to remember that majority of those programs, they come with the caveat, and you need to look into those caveats before you sign up for the program, because most of the people, they get so excited about the benefit of the program that they forget to read the fine print, and there is almost always a fine print. And then one thing that I always tell my clients before they jump on any of the programs, I always ask them to sit down with the loan officer and see if there is a way that we can get the same or even greater benefit through the negotiation with the seller that comes at the close of escrow, and you don't have to deal with it 10 years later when you sell the house, or you don't have to restrict yourself into living in the house for an X amount of time, like if it is not your primary residence. Would that be good approach?
Ask a lot of questions. You definitely need to sit down with the loan officer. Ask as many questions as you can, write down, compare programs, and obviously free money is okay, and it's really good for some people. But again, if I talk about the DPA, I would say at least half the people that I've spoken to that have gotten DPAs, they're not very happy about that, because you're going to get a product that probably has higher rates than what the market can offer, and you're tied in for 3 to 5 years mostly. And once the rates drop and you want to refinance, you can't. So again, weigh in your options carefully, and if it's for you, then apply, of course.
Yeah. And one last question.
Of course.
So how do you, when people shop for rate, can you, first of all, what does it mean, from the standpoint of the loan officer, when people are shopping for rate? And then can you explain to people what to look for? Let's say if they want to compare several lenders, what kind of numbers we're looking at? I've had the situation happen to me when I was refinancing my house, when I was offered an extremely low rate, and of course I bought in, on the offer of the extremely low rate. But just because I have a tendency to read the paperwork, when the closing documents came in, before I signed off, I realized that they were charging me extra $7,000 for that low interest rate that I did not, that has not been disclosed to me or discussed with me. And this is where that rate came from. And so it was not that great of an offer that, at the end, on the closing statement, it was not the great offer that I was receiving at the beginning. So can you please elaborate on, when people are shopping shopping for the interest rates, what should they look into and what kind of numbers they should check so they don't find themselves into this situation where they have a lower rate but they're paying a huge premium for it?
That's It's a wonderful question. Very, very important that every home buyer needs to educate themselves on. And you could just go see a loan officer face to face and spend some time just on that topic alone. I mean, that's a very important topic to cover. I've even made videos that we would send to clients, and it's like 10, 15-minute videos that would explain the document that's called loan estimate. And the loan estimate, that is what came out in 2011 to sort of alleviate this problem of bait and switch, if you will, promise something, then at the end close with something else. That was very prevalent back in 2006 and 7 prior to crash. So we've got the loan estimate right now that sort of prevents this. Now, when you look at the interest rate, you don't just look at the interest rate, you look at the APR, and the APR is basically the blend of your rate plus all the finance charges that you're paying, not the closing costs, the finance charges that you're paying to get this rate. So I could give someone a very low interest rate, but charge them, sort of technically buy it down to a certain number. And you need to be wary, because that goes on page 2 of loan estimate. And some of the biggest lenders in the country, some of the household names are online lenders are famous, notorious for doing this, especially if you're refinancing, especially if you have a lot of equity position in the house. They will charge you thousands of dollars that you're not even aware of. They're not very forthcoming in disclosing that information. So you do need to see what is the finance charge that comes with the interest rate. There usually is one. Whether, for example, we don't build in any junk fees, no admin fees, no lock fees, no doc fees, no processing fees. None of those fees are in our costs. That's a decision that I've made for my clients. And you need to see those things. There's some lenders in town that do that. It's okay, but you need to understand what you're paying.
Somebody's really liking what you're saying right now. But so did I hear it correctly? So in order for me to compare the loan estimates, first of all, I need to get the loan estimate from every lender for the same property for every lender that I'm talking to. Is that correct?
That's correct. So yes, that's correct. But also make your shopping quickly. Don't get a loan estimate once a week, because rates go up and you're not comparing the same thing. Okay. For example, we're brokers by design, which means we could have, there's 2 kinds of lenders: the direct lenders that underwrite in-house, and there's brokers. We broker loans out. And the reason we do this, it's a lot more work for us. It's a bit more complicated a process for us internally, but we want to get the better rate for the clients. So we do go out there and shop. There's hundreds of banks out there. There's tools that can compare the banks and their rates. So not every client goes to the same bank depending on what the rate is. So we're the Expedia that shops for clients a lot of times to get the better rate. But ultimately, you want to look at the APR, you want to get a loan estimate, because that's the legal disclosure of the rate and costs, and you want to compare the APR side by side. And again, the APR is basically, if you take the rate, add all the finance charges, the closing costs, and amortize it over for 30 years, you will have a blended index that helps you compare closing costs. APR is not what the monthly payment will be calculated on.
Okay, so once again, if I'm requesting the loan estimates from different loan officers or different lenders, so it should be a loan estimate where I will see the APR and where I will see the loan costs, correct? Yes. Or the closing costs, and those are the numbers that I should look at.
Yes. Yes, APR is designed to disclose everything.
And one more thing that I think is very important to stress on: you have to do it within a few days, because the loan interests are going to change. And if you stretch it over a long period of time, then probably the lender is not going to honor something they gave you a month ago, correct? Yeah, because they might not be able to provide the rate.
Yes, the market does move, and if someone calls me and they told me that they spoke with God knows who 3 weeks ago, it doesn't hold any weight. Give me something from yesterday, from today, and that's what we can compare to.
Excellent. I remember like once Dave and his team were in our office and they let us look into the back end of their system. Was it 40 different banks? Like we gave David and his team the scenario for the loan, and they were showing us how the back end of the lending software works, where they came up with 40 different banks and quite a few different products that would fit our client's scenario.
Oh, I remember.
Just give us this, just give us, give us a little bit, like don't go into much detail. Tell us a little bit how it works from your end and what is the advantage of the, for the consumer when you shop, when you
Sure.
don't go to one big name bank and you can actually shop with 40 different banks or maybe even more.
When you go to a big bank, big name bank, they typically have one or two products. When you're a broker, we have the opportunity to work with many lenders. So what you just referred to was not a lending software, was something that I had made for myself, for my team. And it basically was a repository, a library of loans. At the moment, we had 69 different programs, which to my knowledge is probably the biggest repository of mortgage products. Basically, as we spoke with clients, we could ask questions, and based on their answers, the software would show us which lender had a product for them. So that allowed us to offer products to a greater number of clients. That product that we developed, whether you are, for example, one of the niche things, let's say you own a marijuana business, or that's federally restricted. There's so many things that prevent you from getting a mortgage. In our library, which was 69 different products at the time I showed it to you, and over 10,000 different loan scenarios, we built that to position ourselves to offer the highest number of products to clients and to offer more loans to people that would get declined anywhere else.
So the rule of thumb, like to me as the person who usually gets to talk to the consumer first before they see the loan officer, is that if your scenario is not quite fit, it does not quite fit into the box, and you have some self-employment situation, the situation where you've been switching from the W-2 to 1099, or you have a very creative tax person working with you, you should go and see the mortgage broker, the one who will help you to organize your finances and your financial documents in the way so that you could qualify for the mortgage. And most of the time, the big name banks will not be interested in spending the time, or will not even have a product offering you, to offer you in your scenario. Is that correct?
The broker typically is going to offer more types of products. The broker is going to approve more buyers than the big name bank. Especially, this conversation is very interesting. Wells Fargo yesterday reduced their position in mortgages. So big name brands do position themselves for the most lucrative clients. For example, Chase only does jumbo clients that have several $1 million of investments with them. And the broker doesn't. We do $100,000 and $150,000 loans all day, where the bigger banks are not attracted and try to shun away from those loans.
And I think we're going to leave it till next week, when we want to talk about different loan programs, because we do have a lot of people asking about, can you get a loan for the investment property for the short-term rentals, how to get a loan that you don't have, like if you don't have enough income, can you still finance the property? So this is something that you and I can actually touch on next week, and also about different types of the loan. What is, what is a non-QM loan, and like what it means for the buyer, and when you cross the line between the QM loan and non-QM, and also all types of different loans, and when is it good to, like, which loan is good to which situation. Like these are the questions that we have not touched upon as of today, but we have the whole week to collect new questions.
Yeah, that's basically your question is going to get more interesting, and I'm excited to answer those questions, because when it comes to investing in real estate, that's where my juices get flowing. So I'm looking forward to that.
So guys, once again, David and I here talking about real estate market, talking about the mortgage market. We're talking about the opportunities that are created in today's market, whether it is in buying real estate, getting the mortgage, and we're talking about those opportunities without pulling your credit. And David, can you touch one more time about the special that you have? And I'm going to tell everybody how to connect with you and how to collect the special offer that you have for everybody who gets to listen to us live or gets to listen to the replay.
Absolutely. So the tax preparation office, which is called IQ Tax, that we own, I am offering up to a $500 value, which is 1 hour of consultation with one of our tax preparers. You don't have to file your taxes. This is not me attempting to gain tax clients. This is me trying to help people that did not qualify, especially didn't qualify last year, that didn't have their affairs in order, didn't have the right education. This is mostly to educate, consult people so they can get the right foundation, because you only have to do this once and then maintain this. So whether it's the right tax form, whether you need to incorporate, get the S corporation, whether you need to get an IRA opened to reduce your tax exposure, whatever your challenge is, we have very good tax professionals, and they will sit down and talk to you and explain to you how to do all that to prepare yourself to home ownership. And from that point on, obviously, you can meet with me, and then we could see if you qualify for a mortgage.
So January is a great time of the year to look into your taxes, to look into your financials, and get yourself ready to be actually eligible to purchase a property, whether it's your primary or the investment property, before you file your taxes. That's correct.
So January is the better time, because come January 24 or early February, tax preparers are so busy, they're skipping bathroom breaks. They're extremely busy for the next 3 months. So if you can come see someone in the next 2 weeks, that would be probably the best opportune time. Other than that, you're probably going to want to see them after June or July. That's when they'll have more time.
And I want to shout out to everybody who felt like in the last 2 years they got pushed out of the market, whether it was through the rapidly increasing prices or through the not ability to make greater down payments. I want to give a shout out to all of those guys and to tell you guys, this is your golden time to actually come and talk to a loan officer, talk to a real estate agent, and actually look back into the market, because there are a lot of opportunities in this market where the prices are getting adjusted, where the sellers are more inclined to give you the credits towards the closing costs, adjust their prices, and to actually work with you, whether the appraised value, whether it is whether we're talking about the appraised value, the inspections, the price, the concessions, and also even with the builders. And David, please confirm one more time for everybody who's going to listen to this one that you guys you finance the new construction loans as well.
We do finance new construction loans. We not only do we finance new construction loans with existing builders, we just added a bank. And we're in the process of adding the second bank, where you can build your own home, buy your dirt, and buy your home. So we're going to do construction loans.
That is exciting.
Yes, we're working with vetting some of the contractors that will be approved by the bank. And you can bring in your contractor and vet them. And that's exciting, because I see the low inventory in Las Vegas is going to push more and more people to build their homes themselves. Excuse me.
Hi, Steph. So, guys, once again, this live will be saved on my and on Dave's Instagram pages, and also in the description. Feel free to find the contact information for David for the tax preparation office that David mentioned, and also contact David directly if you wanted to use the opportunity of getting a tax consultation. Hi, Stephanie. We have Stephanie Grant, our dearest friend from Las Vegas Association of Realtors. She's actually on the board of directors of the association, and she's right next door to you. Stephanie,
yes,
if you have not... Yes, if you have not had a chance to meet David yet, you can just go one door down. Yep. They're right next to the entrance to the association, and David is one of the best knowledge brokers here in town. I'm sure that you guys are going to have a very enjoyable conversation, as Stephanie does a lot of business here, and she's been in for a while, and she knows all the ins and outs of what is going on with the market. Thank you, Stephanie, and thank you. Yes, sure.
Alexandra, I want to pose a question to our audience, because I understand lots of people are going to watch this. And the biggest topic of last year was, David, I'm going to wait to buy until rates drop. I mean, I'm just going to wait until rates drop, then I'll buy. So I want to pose a question to your viewers. Guys, what happens? Post down below. What happens when rates go down? This is such a important question to answer. So if you don't mind, I want them to type below, once they hear this question, what happens to the market when rates are low? What happened to the market when rates were low the last couple of years, 2021? Okay, and I'm even enticed to give them a gift or something once whoever responds to this. So we'll talk about that later.
I'm not going I'm going to give my opinion probably next week.
Okay.
But there is one thing that I always ask people to remember, is that, guys, nothing happens without the reason. And remember that the last time we had super low interest rates, remember the cause of it. We had 2 years of pandemic. So if you're thinking that the interest rates are going to go down just because, it is not going to happen. So something major and something really comparable to the pandemic and to the total economy, like to the jeopardy of the economy collapse, has to happen before the government just pushes the rates down. So when you're thinking about it, if you're not looking at the major dramatic event happening and the major economic, turn down happening, then the rates are most likely not going to go down. So Stephanie says there are more opportunities for buyers when the rates go down. That is Stephanie's opinion. So her buyers are absolutely having more opportunities, and I would say everybody wants the lower interest rate, and everybody wants the lower, refinance opportunities. I 100% side with Stephanie on refinance opportunities, because if we look at the stats, like within the pandemic years, pretty much, what was it, David? Do you remember the number? Was it like 78% of homeowners refinanced during the pandemic years? It was some kind of like some crazy number of people who refinanced their homes during the pandemic years just because the interest rates were super low, and it is extremely important, guys, you know, like that's why you watch the interest rates and you stay tuned and you follow people like David and you follow what they say, because when David goes onto his Instagram and he says, hey guys, it is the time for you to look into your mortgage slip and compare what kind of rate we're offering today, what is compared to what it says on your mortgage slip, then go ahead and, you know, like go ahead and refinance or give Dave a call and ask, you know, like, David, is it a good time to refinance, or this is my rate, you know, like, is there an opportunity for me there?
Yes, talk to us for sure.
It doesn't cost, correct? It doesn't cost you. Pick up the phone and ask your questions, guys, and this is what I love about David and his team and their office, that I probably ask 10 million questions every day. And I run the scenarios by them, and I, you know, like I go by their advice, and my clients also trust David with his expertise and his team with everything that they do.
You told me I'm the extrovert, so we do talk. We do talk all day, that's for sure. We do answer questions all day. That's our job. So talk to us, guys. Call us.
And thank you so much, David. Thank you for your time today. We really appreciate every piece of information that you gave us. Once again, David information is going to be in the description to this live. We're very grateful, guys. Please do respond to the question that David asked. What do you think happens to the real estate market, correct?
When rates drop. When you have a low interest rate environment, yes.
So you're going to give a present to somebody next?
Well, let's talk about that. You and I will discuss this.
Yeah,
I'm not too sure why not.
We're going to do something special for the person who gives the best answer, and then we're going to discuss it next time. Thank you, everybody, for joining us. Please leave your comments. Let us know what else you want to know about mortgage, what kind of or real estate market, and what kind of questions you need the answers to.
Thanks, everyone.
Thank you. Have a great week.
Thanks, Alexandra. Appreciate it.
Thank you.